Hello and welcome to this Trades and Tutorials video. This is Jeff Bish, president of MarketGauge.com. And in this video, I am literally going to rip one of the tactics out of our Trading Essentials trading program and share it with you because the IWM has just had an historic run, a run of over 15 straight days in a row of being up. That's the most in 20 years. Yesterday, you can see we broke the streak with a down day. And I want to make sure that you know how you can pretty easily catch these major moves down and these major moves up, even these little minor moves here, and get into these quick moves here, but do it with a systematic way of understanding how to control your risk and know when you have overstayed your welcome on an uptrend and when a downtrend is shifting so you can get in early. In other words, if you can get into these medium-term swings in the market that often lead to these massive moves at a relatively quick transition in a trend change and have the confidence to ride that trend, it makes your trading a lot easier and I think a lot more fun. Now, I have to warn you, I cannot go over everything we teach you in Trading Essentials. And one of the things I am going to leave out in this particular blog, but we are going to cover one aspect of it in an upcoming free webinar, which I should have links to on this page, or maybe something will pop up and give you the opportunity to get in. And that is looking for short-term patterns that identify the precise time to focus on an entry. So let's take a step back and focus on some of the bigger picture stuff that we teach here at MarketGauge, and that is phase changes. Now, this video is not about phase changes. But if you have that groundwork, then what I'm about to show you will be even that much more powerful. So the bigger layer underneath this is the phase. And the green line in this chart is a 200-day moving average. The blue line is a 50-day moving average. We're looking at the Russell 2000 ETF, the IWM. And the magenta line is the 10-day moving average. And that's where I'm going to focus your attention in this particular lesson. But before I do, I just want to make sure that you're also familiar with phases, and you can find more information about phases on our website. It's also in Trading Essentials. You can get it in Mish's daily newsletter that goes out. So if you're not signed up for that, please find that. All right, so the idea of the phase is that if the general market phase is bearish, where you've got a 50-day moving average under a 200-day moving average, that's going to be your big picture trend. And if you're trading against that, you're trading against the major trend. When it turns bullish is when you've got the 50 over the 200. Now, there's actually 6 different phases that we look at, but for now, those 2 conditions are situations that you want to be well aware of. But you don't always want to wait for a phase change. So here's a phase change. Here's a phase change. You don't always want to wait for a phase change to determine a trade entry, especially if you know this. And this is a simple concept which I call close and continue. And you can apply it to a lot of different setups in the market. But one of my favorite ones for the medium-term swing trade focus, so that's anywhere from several days to several months of a trend. If you want to catch that both quickly and stay in it for the longer term, whether you're trading options or stocks, here's one way to do it. So the idea of close and continue is that you've got a line, right? And in this case, let's call this line the 10-day moving average. And if you've got the market, which I'll put in red, the market trading under that line, we want to see the market close over that line, and then the next day continue higher. When you get that pattern, it's an indication that the trend, which is the line, is reversing. Now, it works on the upside, it works on the downside. Let's take a look at it in the market. I'm just going to use the IWMs as an example. And what you want to do, so trick number one in using this is that it will not work in a flat market. So as soon as the market starts to go flat, you want to be really careful about using this. The best time is to look for turns or pullbacks in a trending market. All right, so in this case, if we just start from the beginning of this chart here, the market clearly has some momentum on the downside here. And rather than try to figure out where it's going to bottom, you can use this tactic of it has to close significantly over and then continue higher. Now, I further enhance the continue portion of this by insisting that we also have an opening range breakout. That'll be a topic on another video. I've covered that in other videos here too. But to keep this really straightforward, let's just focus on keeping you on the right side of the market and in and out at the right time with this blunt but powerful view. So in this case, this would be your continue day. Now, I'm not going to lie to you, it doesn't always work. This one didn't work, right? It didn't work in the sense that once you close and continue, you really shouldn't have a significant move back down under the 10-day moving average and move lower. Now, why didn't it work? Well, for one, again, you're going against the major trend, against the major phase. And number two, this is really its first attempt down here. And I don't know what kind of support is over here. My guess is not a lot of recent. So if you were to continue with the concept, however, and you're either out or you're bearish through this and you're waiting to get bullish, here's your close, here's your continue. Now in this case, you have a situation where you're basically picking off the bottom, right? And so why do you think this one would work when this one didn't? Now it's not always going to be the case, but you've got a double bottom here, right? You have a very clear rejection of this support level. So there's better evidence that that one's going to work. Now, if you were just to follow the same basic rule of I don't want to get out of my entire position until we close and then continue in a significant way below the 10-day moving average, you're in through this whole thing. You're not out here. You're not even out here if you use the opening range because it doesn't take you out here. Here's your close. Here's your first close lower, but here too, I know because I was in it, we didn't take out an opening range low, so you're still in. Now, here you have another close underneath it, significantly below it, but you never continue lower, so you're still in. So here you are, getting in as close to the bottom as this type of a strategy will allow you to get in, and you're able to ride this whole thing. Now, the other trick to being able to ride this whole thing is to be able to take profits along the way so that when it gets iffy or perhaps a little nerve-wracking trading under this level, you're not doing it with a full position. Now, here's another benefit of knowing how to do this, and that is that when you realize that the close and continue will tell you when the trend is going to change, these become head fakes, right? And when you know how to trade the head fakes, now you've got to trade for buying retracements. So in here, we close and then we continue lower, and then you can see it spends a fair amount of time underneath the 10-day moving average. And what are you waiting for again? You're waiting for that move above it and then the continue, and again, off you go. Now, you're not always going to catch a multi-month move, but certainly that's a really nice move. And here's your close. Here's your continue. Certainly, even though this wasn't a massive move, you could make some money on the way up. You get out here and you're good on the whole position. Now, here's your close to confirm or to suspect that it's going to move higher, but it never continues. So you would not have gotten caught in this. Here's your close back over. Here's your continue. You may have gotten scared out here, but again, opening range and you never closed underneath it keeps you in it. And then you're in it all the way to basically up here. A nice long ride. All right, now here is one where you get caught looking for that bounce off the 50. That one didn't work very well, and your close underneath it and continue here keeps you out of all this. You never continue to the upside here. You get this, you get the picture. I mean, we're talking about a massive move through the whole year, and you've pretty much been able to time these major swings very easily and applicably. Now here, we bounce off the 200-day moving average, we gap higher, there's your close, there's your continue, and you're still in it. All right, so how does that play out right now? Well, and what do you do if you're not already in it? Now, I've given you an example here of the overall market, but this works on individual stocks too. So you can use this, and I do this for our members of many of our services in the weekly videos I do for them. I use this as one of the inputs to figure out which way the market's likely to go over the coming week. Where are we in this measure of this trend? Are we in a bullish mode? Are we in a bearish mode? Are we in a transition mode? Right? And all that can be determined by what I've just told you. So if you're in it now in the market and wondering, is the market going to roll over? You can very objectively say, I'm just going to wait for the last part of my position to have the close and continue on the downside. And until then, this market can consolidate for quite some time. As you could see here, even though this one turned out to be the high, this consolidated for a long time before it finally really broke down. This could have just as easily gone this way. All right, we could get the same situation like that here. And I'm going to show you an example of a stock in just a minute, which has in fact done that. So while the overall market in the IWMs has been very clean and straight up, there's stocks that have not been. And so let's just take a quick look at this on a couple of stocks. Now I'm going to use Apple because I know a lot of people like to trade Apple. And let's just take a look at it from, let's say, the lows in here, right? Closes over. Now keep in mind we're in a bearish mode here, so not surprising that when you close and continue here, you catch a nice move here. You're not out there, but you wind up getting out here, and it comes all the way back down. Now, but you're kept out of this, right? You could have gotten in there, and you're getting out of here. Now, close and continue happens in here. It moves higher. This one was tough. Close, I would say, is continued. You get stopped out there, but then you got earnings. So that's a whole nother animal. So let's just say you're not in there. You're waiting to see for it to when it will roll over. You've got a close and continue pattern in there. Keeps you out. In here, you do get caught here. You're out here. You're in here for all this move, which leads you all the way up to the highs. This is earnings, so your choice whether or not you want to take that risk. Let's say you did, you got your close and your continue in here, keeps you out. Bounce off the 200, close and continue, and you're still in it as it's consolidating in and around this 10-day moving average. Now, another nuance here with understanding this tactic is if you understand how this works and you see today, for example, Apple comes down and has an opening range reversal right at its 10-day moving average, right? That's about the same location you'd be getting in on the close and continue. It's also a pretty significant support level. So you put all that together, so combine this with patterns, an opening range rule, and just a basic understanding of how to use this close and continue on the 10-day moving average. And even though the market has taken off and can be somewhat, IWM is very extended, you've got stocks like Apple that aren't extended. Now, Apple isn't my favorite pick, primarily because on the triple play indicator, it's not nearly as strong as, say, a Boeing, which I took advantage of today. Let members know about this last night. And it's all based on, on triple play, but also on this close and continue. So as the overall market has had a really strong move up, Boeing at the same time pulled back, had a retracement to its 10-day. Notice it couldn't give you a close and continue on the downside, and right back up. In this case, I was focused on Boeing because one of triple play, two because of the pattern here, and one of those patterns we're going to show you in the live training that we're doing soon. And you can see Boeing has exploded higher today, and that's in part due to the fact that its trend is much stronger than Apple's. But the point here is that if you go back and look at Boeing from the transition here, close and continue, keeps you out. This closes, but it doesn't continue. That continue is really important. Basically keeps you negative all through here, turn positive here, continues here, and once you've done that, once it continued in here, you have not had a close and continue with an opening range. This closed, but opening range kept you in all the way up through here. So it works on stocks, it works on ETFs, and if you combine it, as I said before, if you combine this with a few other things like short-term daily patterns, like the opening range, like the phases, all of these things we teach here at MarketGauge. And we put all this together for you in the Trading Essentials, but this is just one part of it. So if you are interested in something like this, you might want to consider Trading Essentials. But whether you do that or you don't do that, use this close and continue around the 10-day moving average. And as I said, it'll help you stay in trades longer, help you get into swing trades quicker, and it's a really powerful perspective. Hope that helps, and I'll see you in the next video.